Hello and welcome to The Resilient Investor with me, David Stevenson. Now, let's go back to basics, a terrible political term which shouldn't get used again. But when we talk about investing, everybody always sorts of immediately jumps to questions about what should I invest in? Should I invest in equities? Which company should I invest in? Should I invest in Nvidia or not invest in Nvidia? Should I invest in bonds? You know, all these kind of questions keep trotting out. And I want to sort of dial us back and go back to basics and say, what is it you want from investing? And in reality, what most people want from investing is they'd like a very steady return. So they'd really love kind of 10% a year ad infinitum. They're probably not going to get it. But they'd like something that's a fairly steady return over a long period of time. And they'd like, say, something, I would guess, in the kind of 5 to 10% per annum, preferably real. But what we mean by that is after you're taking inflation off. But anyway, 5 to 10% per annum, you know, something in that range over the next 10 to 20 years. That's probably what a lot of people really want. And what they do is they automatically go, well, that doesn't sound like equities or shares, because they think, oh, it's volatile, isn't it? Shares are very volatile. They go up and down, and they go, and everybody talks about Nvidia, and they go, oh, it's quadrupled, and then they'll mention some other company that's gone down by 85% in share price. Most shares aren't like that, yeah. But I would argue that also that people then quite quickly go, well, if I want a steady return, I'm going to go for bonds, yeah, because bonds, kind of IOUs, where you lend money to a borrower, they tend to be less volatile, although they're not as unvolatile, unvolatile not being a word, as you think they are, because you can actually suffer big losses on bonds for extended periods of times. But they tend to say, well, you'll get kind of like 3 to 7% a year from bonds, yeah. I can't remember what the rate is at the moment. As we're speaking, I think the 2-year government gilt is running at about 4%, 3.5%, 4%. Yeah. And, you know, you might get a little bit more if you lend to the government for, say, 10 or 20 years, but kind of 4.5% maybe at a push. And that all sounds sort of very steady and kind of like pretty boring. And what I'm sort of going to ask you to think about is, if what you want is a 7 to 10% return a year on average over the long term, compounding out over 10, 20 years, maybe think a little bit outside the box. And I want to come to talk a bit about investment trusts, and particularly the infrastructure and renewables space. Not a popular space at the moment, it has to be said. What I mean by not popular at the moment is a lot of the shares are trading at quite big discounts to what the shares are worth. But in reality, if you look at the profile of a lot of alternative investment trusts, they sort of trying to deliver and mostly succeeding and delivering on that promise of sort of between 5 and 10% per annum. And what you get in that 5% to 10% per annum return is a combination of both the income play, which is the dividends, and you also get what is called net asset value growth or capital growth. And you get the combination together and you put them together and you get a total return. And that total return could be between 5 and 10% a year. And the kind of variety between income and capital can vary. Some funds have a little bit more capital growth. Other funds have a little bit more yield growth. But with quite a lot of them, you get a bit of both. Which brings me nicely to my guest today, which is Ross Driver, who's a fund manager at Foresight Solar, which is one of the investment trusts in the alternative investment space that I've talked about. And it's a really good opportunity to catch up, Ross, because what we're going to talk a bit about is that kind of total return, how you can get both yield and a bit of capital growth. Talk a bit about renewables, because that's obviously a big sexy subject, certainly in the UK, lots of renewables around the UK. Talk a bit about solar. There's amazing curves. If you ever want to see an amazing graph, go to a thing called Our World in Data. And it's a fantastic website which does kind of global data. And they've got this most amazing chart of the declining cost of solar power, of solar PV photovoltaic cells. It's just a staggering chart. It's just literally falling off a cliff. And we have the Chinese thank for that. Anyway, so we'll talk a bit about solar. We'll talk a bit about renewables, a bit about alternatives. But first, Ross, welcome.
Welcome, David. Yeah, pleasure to be with you.
Lovely. Now, Foresight Solar, give me the kind of 30-second what it does on the biscuit tin test. What is it?
What it does on the tin. So the fund's been around for 10 years.
10 years now?
10 years already. We had a 10-year anniversary a few months back. And that's pretty much what it says on the tin. We invest in large ground-mounted solar projects. Right. So started in the UK off the back of the subsidies that were put in by the government at the time, sort of late noughties, early 2010s. Yep. Built up a large portfolio in the UK. And then we've diversified internationally. We've gone to Australia. We're building up a pipeline in Spain.
Right.
And then the only other change we've made really in the technology-wise in recent years is we've added an allowance to battery storage as well. The primary focus still remains solar is 90% of the pool.
And this is the solar you see mounted on the ground, not on roofs.
It's ones, yeah. We're specifically not in rooftop. There are other funds doing that. We're primarily on the large scale ones that you'll see if you're driving up.
Yeah, I was going to say, well, you go past on the M motorways or the A's, you see them. Yeah,
You'll see it. You might see the top of the panels over a hedge. So it's those kind of large sites. And yeah, we built up one of the largest portfolios in the UK. Between about 2013 and 2017. And
your market cap, the total value of the shares outstanding?
Current value of the shares at the moment, and you've made this point, that things have dropped off. We can come on to that. We're circa 500 million.
Okay, so quite big fund.
Half a billion. We're in the, I would say, medium to larger category.
Yeah, so a lot of liquidity. But I'm imagining that what we call the value of those assets is greater than the market cap.
Well, this is where we come back to, we could talk about it very long.
Which I'm sure will.
Why we see it as we feel ourselves and the board who help manage our trust feel that those assets are quite undervalued at the moment. We're actually seeing, particularly for the UK assets, and the value from the long-dated subsidies in there from the government, but also the power prices that we can sell at. We do feel that they're undervalued. Our NAV or our asset value.
Yeah, the total value of all the assets in the fund.
The value of all the assets. I mean, we are currently at about, I think as today, it's about 27% if you take the under.
So you're 23% below.
27%.
27%. Wow.
Below the value in terms of what the share price is trading at today.
Yeah.
Versus what we think the fair value of those assets are.
Okay.
Just say it's not. As you will well know, it's not something that's unique to
some are much worse than that.
Even our subsector of what I would say renewables infrastructure, that's my background for 20 years. But it's something that's affected the whole market at the moment because of that disconnect between sort of fair asset value pricing.
So going back to my earlier point, Ross, about what the total return is. What kind of return should investors expect from this? Because I'm imagining it's not. You're not talking Nvidia style returns, doubling your profits every year or something. No, it's just not that kind of asset, is it really? No. So what's the kind of total return profile? And notice I said total return here, listener, because I sort of said there's both a combination of capital growth and income growth, which we always forget. So how does that all what's the aim? How's that all flesh out?
Absolutely, and happy to talk to that. And I think, no, we're not Nvidia, we're not the Magnificent Seven, those kind of growth stocks. Infrastructure should be boring and reliable.
Exactly.
That is what we should be. And there's a variety of spectrums there, from sort of very much the yield play, which should be safer, returns that are primarily coming out of the dividend that are being paid out.
And quite often in the market, that tends to be kind of in your 4 to 6.5% range.
Around that. And the 6% range was, to be fair, I think where a lot of the funds started off.
Yeah, and they went down.
So, most of the funds launched, to give listeners a bit of an idea, most of the funds will have launched at about 100 pence a share, and most of them were giving, ourselves included, around a 6 pence dividend at that time. So it's about a 6% return. If you look at it today, our dividend is now up to 8 pence, so it's grown 33% in those 10 years, but trading over a NAV that's slightly higher, so a value. What's coming out of the dividends alone is just under 7% if we were trading at what we think is fair value. Yeah. At today's share price, that yield coming off is closer to 9%.
Okay.
And that's just because of where the share price is today.
So we've already identified two elements there. So we've got both the dividend payout and the dividend payout relative to the share price.
Relative to the share price,
which is at about 9%. Yep. Then you've got dividend growth because you've gone from 6p to 8p.
Absolutely.
And then you've got the total, and you've got the capital gain, what we call the NAV return.
Then you've got the capital gain. So I think one of the things that we should acknowledge, actually, because I think the whole industry, I'm a renewables guy. So actually, in terms of us, it may be relevant for the wider sector as well. But I think you could say traditionally for the first sort of most of the 2010s up to about 2020, when we've had the sort of latest market fluctuation.
Yeah, with COVID. Yeah.
Most of the funds, ourselves included, have been yieldco plays.
So what we mean by yieldco is it's a company that is primarily focused on giving you a dividend check.
A dividend check there might have been a little bit of asset growth because we started to bring through construction projects and more likely development projects. But I think, look, as the real where the disconnect has come is through this rapid increase in the base rate as we see it.
The interest rate,
The interest rate.
Which has gone from close to 0 to 5.25%.
5.25% here in the UK, similar things. And that was the biggest, as you all know, it's the biggest the biggest movement in that in a generation in about 40 years.
Yeah.
So there's become a disconnect there, I think, between what investors are looking at and what the fair value of these assets are. And I think the way that we're looking at it now is we've moved away from, we haven't invested in operational assets. So
it's important to say that with a lot of the funds in the renewables space, there's a difference between where riskier early stage stuff where you're developing stuff, and then there's the later stage stuff where you've developed it, constructed it, it's all done, and it's just you've just pressed a button, it goes on. I'm sure it's a bit more complicated than that.
That's the best way to think about it. So a lot of the funds at the beginning would buy operational assets.
Yeah.
So they're well set up to give you that nice yield because you agree, well, that's a fair value to pay for that site that somebody else has developed. You do your DD on it and hope you plug it in, sun's going to shine, it's going to pump out.
We will come back to the sun shining later, but
but it should give you that nice steady return that's sort of synonymous with a yield, a good quality yield. So we've already got that in the portfolio. Where we've moved in the last few years is moving into construction. So
which is a little bit riskier, isn't it?
A little bit earlier. You then have to take the risk of actually signing construction contracts, getting that project built within a set time frame.
And listen, we mustn't underestimate that that's not as easy as it sounds, because there's if you've bothered reading any newspapers, you might have noticed there's a distinct shortage of people who can connect things that generate power to the grid. And there's lots of inflation costs going on around, and there's lots of skill shortages. I heard some amazing figure that this is just a weird story. There's these things called DNOs, district network operators, isn't it? Yep. And they're the people, you see them going around in their flatbed vans, SSE is my local one, and they're the people who do all the local stuff, so not the big pylons, but they're the stuff that distributes to your house. And I heard somebody told me recently that the average age of the engineers until fairly recent was probably in their late 50s. And they're all basically retiring, and therefore, so when people say, "Oh, I've got myself a new solar park or a new whatever it is generates power, I'd like to hook it up," they go, "Well, I'm afraid there'll be a 7.5 year waiting list to get on." So construction's not an easy job.
No, absolutely, you hit a nail on the head there. Actually, the delays in grid and getting these connections through is part of the challenge, which sort of may present a real problem in terms of meeting net zero targets. So getting the grid there. So managing all of those parts is quite difficult. And then you can actually go a stage earlier than that, which is to go into the development of the project.
Right.
Where typically you either have it in-house or you partner with someone, which is our sort of strategy, that actually getting those projects through the design stage and into getting planning permission.
I was going to say, which is, as we all know, no easy task.
Yeah, I mean, it's equivalent to thinking about getting planning permission for an area of land.
Yeah.
And once you get that permission, obviously that land is a lot more valuable.
Yeah.
Similar with so you'd have to have a bigger portfolio. You've got specialist developers who are effectively running around the country trying to find
a nice field with the rights.
Negotiate with landlords, get a deal packaged up, and that's their area of expertise. And then they're obviously looking for people with money. We channel the money into these things to take them forward.
So the combination of doing more construction or development means that it's a bit riskier. I mean, it is riskier.
Yep.
And you hopefully get a better return.
And then that's where you would say, actually, that's where you can start to see some valuation uplift, because moving from each of those stages from one to the next,
fundamentally, it becomes more valuable.
It becomes more valuable.
So because basically you've got a field owned by Farmer Giles, it's probably worth whatever the going rate is, 4,000 quid, you know better than I do, per acre, and then put planning on it for solar panels, imagine
grid connection,
then the grid connection, and then you've actually built all that out. That value of that is much greater.
Exactly. Yeah. And then, I mean, we've started to realise this in terms of we've done that in Spain. With a
lot of sunshine.
More sunshine in Spain, but you pay more for the projects. They're more valuable.
True,
so it's all a bit of a trade-off in terms of that. But we've done that. We brought a project through construction. We brought debt into financing it. We signed a long-term off-take agreement for someone to buy the power because there aren't any subsidies these days in Spain.
Yeah.
Done that, and then we've actually sold on 50% of that asset to another investor to come in.
Okay, so what you're saying is that you started off in the nicest possible way, terribly boring.
Absolutely.
And you've become a little bit more exciting, but you've still got the yield that's still paying out, but you might have a little bit of capital growth as well, we're hoping. And what do you think that might amount to?
So in terms of, I think in what you'd class as the yield plus the growth being more of a total returns play, which is what you explained at the start. I think you're looking at about 8 to 9%.
Okay, which is
solar fund, which is at the more attractive end, because and actually, we come back to this, is that I've no problem with us being referred to as boring and maybe a little bit more exciting in these, because you look at it, actually, I think solar is one of the least volatile.
Absolutely, because
technology's out there.
Because it tends to rise in the morning and set in the... Anyway, we'll come back to the physical dimensions of solar. Okay, but so from an investor's point of view, just going back to my original point, people always start off equities versus bonds. There's sort of, although the shares in the fund are equities, it's important to say that. So they are equities. Investment trusts are equities. So you are buying into equities, but you're really more like a bond. In many of its or certainly were originally more like a bond. So aren't you really more like all of you, and not just your fund, but a lot of the alternatives? You're more like a kind of hybrid, aren't you? A hybrid of bond-like characteristics and equity-like characteristics in a total return package. Yeah,
I think it's fair to look at it. There are characteristics of both.
Yeah.
So I think we'd always say, because as you well know, there's been a lot of discussion around investors about, bonds have become more attractive again. To a lot of investors, they've dusted off their...
Yeah, well, certainly if you get a lot more yield on bond now than you ever did before.
Exactly, they're 101 how to invest in gilts again after it's been in the draw.
I've even got a few gilts, that's quite amazing. But anyway.
But if you think about it, I'd say what you wouldn't get is the same return on gilts as you would from us, or that kind of... you will have an annual step up in the actual dividend as well.
Yeah,
increase.
And the government doesn't do that. The government doesn't go, actually this year we'll just pay you more, and
we'll just pay you more.
It doesn't work that way.
In your bonds. So it's a progressive dividend. So that means, from our perspective, that means it should step up every year. We increased it by 6% for this year going forward. Right. Obviously, a lot of that was linked to higher inflation. Yeah. We can't promise it's going to be 6% every year, but we should expect it to give up and give a level of inflation protection out of that. And then the other side of it, obviously, your bonds won't typically do that unless you've got index-linked ones, and then you'd get much lower yield on them anyway. So you've got that uplift, and then you've got the potential to enjoy capital growth. Modest capital growth. We're not talking,
we're not talking Nvidia, or we're talking 1 or 2 or 3% a year.
7x. It's exactly that.
Yeah.
And the idea, we can go into a little bit more about how we think we're very well placed to achieve that. But effectively, what it would be doing is bringing through. We're looking to move the fund to more of a trading strategy now, and because of the certain market dynamics, we're having to sell a number of assets. We've earmarked 200 megawatts to sell off, to recycle some capital, which means sell the assets down to pay down debt in the current market environment. So because debt's become more expensive on the floating rate debt. But actually, we see that as this is actually the start of a transition into more of a trading strategy. We want to bring more and more projects through from our pipeline development. We've got 500 megawatts, which is development pipeline in Spain at the moment. And to just give you an idea, our portfolio as a whole is 1,000.
Oh, so it's a big old project. It's
quite a big project. It's 6 to 7 really big size projects coming through in Spain. But we'd like to grow that pipeline to about 2 to 3 gigawatts, which is 2 to 3,000 megawatts.
So growing.
To be coming through, and different, like UK solar, some co-location, maybe a bit of storage in there.
Yeah. By the way, just so it understands, when we talk about storage and co-location, what we really mean here is the sun doesn't shine in the night. You might have noticed that. And therefore, quite often more people want power in the night. And therefore, if you've got a battery situated next door to the solar, you can feed the power into the battery,
charge it up, and
then release it at night. Yeah. Okay, so let's just talk. So this brings us nicely then to power prices.
Yes.
Now, it will amaze people, I'm pretty sure, when they have to pay their power bills, that actually the wholesale cost of power has actually been declining.
It has, and
which is significantly, which I'm sure was stunned most people, because they think, bloody hell, I'm paying a lot more. But actually, talk me through what's been happening to what we call wholesale power prices and whether or not they impact you. Because I suspect they're not. It's not a direct one for one. So I don't know. So power prices at the wholesale market go down 10%. It doesn't mean your revenues are going to go down 10% because you've already said you get some are legacy assets with subsidies. Yep. And it's different. Maybe it's structured in different. Talk me through. So power prices have been declining. Does that affect you?
It does, from the fact of looking at what we have. We get power curves which are forecasts through consultants, and most of the market look at that. Most of the market take a range of at least about 3 different views of forecasts of power prices. Now, in the long term, they haven't really changed much for the last sort of 10 years or so. That we come down to a power price in sort of base terms or real terms of about 40 to 50 pounds a megawatt hour. I mean, we've had the massive disruption of,
Ukraine.
About high. Well, I'll go back before that. Because
COVID,
just to give, COVID for a start, because we actually hit rock bottom prices.
And just listen, the reason for that, of course, is because lots of people were working from home and not working in big, smelly factories.
There was no industry.
And there's no industry. Well, apart from the bit that had to stay open. But all the rest of it got shut down.
Absolutely. So we went through. So the power prices were sort of quite reasonable back then. And the way we look at it, we actually sell the power from our solar projects. We sell it forward at several years in advance.
Right, okay.
Because we always focus, we say we are not energy traders.
No.
We're asset managers, really. We know the infrastructure that we buy into. We don't try and second guess where the market's going. And it's going back to we want to live in that nice, boring, stable income to people. So what we tend to do through our portfolio teams is we'll sell forward that power up to between sort of 1 and 4 or 5 years in advance. So that's what helped us in a way. So we were already pushing. So you try to smooth out the ups, the troughs, and the
peaks. Eventually must catch up with you, though.
It does eventually. And the way to look at it is actually that strategy helped us get through the pandemic because the power prices dropped so low. If we hadn't already fixed the prices on some of that, it dropped so low that we might have been struggling to pay out, have enough cash to pay out the dividend to investors. At the same time, when prices spiked, we'd already fixed a lot of that at much lower prices. So we didn't. It's not like we enjoyed all the benefits. You're right in terms of it caught up. Things did get a bit tighter during the pandemic. We did have the most strategic we got in terms of trying to, I think, sort of second guess energy markets. That's a very dangerous thing to do. But during the pandemic, kind of thought it was only with people going back to work.
They are probably going to
one way this is going.
Exactly.
So we left more on what we call a merchant basis that was more open and
more short term.
More short term. But I don't think any of us ever expected we were going to see 300, 400, 500 pounds a megawatt hour. And now that the key thing for listeners to understand as well is a lot of that is set by the gas price. So we've had, and the gas price is the marginal cost. It's the price that sets the market price in the UK and many other places.
And everybody always thought that with Russia sort of cutting down its gas supplies, that therefore prices would shoot up. And the paradox is although they did shoot up for a while, they crashed down again because, of course, the Americans went, rubbing their hands, went, guys, and the Qataris, here's plenty of natural gas. And and we, of course, pay more than poor, benighted countries like Sri Lanka, like Bangladesh in the UK. So we got all their shipments as well. So actually prices then came down again. And natural gas prices, talk about volatility. They're all over the place, aren't they?
Oh, absolutely. They've come down significantly. And I think that they're moderating back down to a level that is going back towards the long term.
Okay, fine.
Really. So I think the important thing is, and there's been quite a bit in the, as we'd say, the sort of analyst cover of the sector, so the professionals who sit there crunching the numbers on what all our trusts do, and sort of looking and going, actually, the important thing is most of us have fixed our positions for several years out now. So we're in a very comfortable position to pay the dividends. It's sort of, we got cover of at least, we got 1.5 times or plus times the money that we actually need to pay it for the next couple of years. It's what happens sort of in the latter half of this decade as those power prices come down. So we've got access, we have different routes through to market, different entities that we can sell that power to. And the thing is, although the prices have come down, they are still above. They're coming down to a much more manageable and sustainable level. But I think all of us, frankly, need, because our energy bills have been off the scale recently. But it's still at a level that's slightly above where we were sort of pre-pandemic.
Yeah, still above that.
So it's been above that,
Talk about falling prices. The solar cost curve. I mentioned it earlier. Go to our world in data, look at the cost of solar, and it's just it's like it's fallen off a cliff. Does that impact? It must have an impact on you at some point, because it must mean in simple terms, it costs us to buy solar panels, surely.
Exactly. And in a way, it will impact us. It impacts us for the future. So it's all, as we came into saying before, the value add and where you can add value in these structures in what is one of the most straightforward renewable technologies.
Yeah, I mean, without what sound terrible, you don't need to be a rocket scientist to buy a solar panel, plug it up. I mean, you need to be a DNO engineer to plug it in. Yeah. That's a separate issue. Yeah. They're maybe not rocket scientists, but they probably pay like rocket scientists. But anyway, but it's not massively complicated, is it?
No, it's about structuring the deals. Really.
Yeah.
What's a fair price to buy the right software developer to, like, one of those consented, a site that's got planning permission?
Yeah.
Because they will know what they can sell it for.
Yeah.
You've then got to line that up with what you can buy the panels for.
Yeah.
What you can get
But panels have come down massively in price.
They've come down massively in price. I'd say it's when we're looking to build new projects that it's more.
Okay.
Because actually our panels have a sort of technical view on them is that they could last for 40 years.
Oh, really?
Some of those, I mean, a lot of our sites are coming up to 10 years old now.
Okay, because the rough yardstick is 25 years, something like that, isn't it? Normally 20, 25 for most domestic ones.
On a warranty.
Yeah, no warranty. Yeah.
But that's the assumption that they could.
Well,
whether we actually run them into the ground that much, because they do degrade.
They do degrade
every year. It's like not as bad as your phone battery or anything like that, but they will become less efficient. But there'll become a tipping point where, with the new efficiency of these panels, what we'd do is actually repower them, which is strip out all the old panels, send them to recycling, and fit in new, far more efficient ones. We don't see we're going to have to do that on our sites anytime soon, but what it does mean is that the new panels coming through are far more efficient, so you can therefore capture a lot more of that.
And how much more efficient are they? I mean, is it possible to put an estimate on it?
Well, I think the efficiency of most solar panels is, I mean, in terms of how much energy they generate, we're somewhere in the mid to low 20%. So it's not necessarily the most efficient, but in terms of step change, they can get them now into the sort of 30%.
Oh, which is a big difference.
If you think is a step change in terms of order, it's about a 20 to 25% uplift in
completely,
terms of efficiency.
and probably cheaper.
Cheaper, and you can now get what's called you've always been able to get what they call bifacial panels, which is a bit of an interesting one, which means they've got the solar cells on both sides of the panel.
Oh, wow.
Why would you want that? Because one's facing the sun,
and one isn't,
pivoting around, and one isn't. But the light can even reflect.
Because there's a lot of ambient light, isn't there?
Ambient light and bounce back up again. So you can really see, and they're no more expensive than a single-sided. So why don't you get them?
And listeners should know there are various stories about how cheap solar power has become now. I mean, if you go to parts of America, particularly like Arizona and Southern California, where you basically large bits of a desert, and you stick in solar panels. And actually, there's been all these apocryphal stories of the local utility companies actually saying we're going to disconnect all the solar because there's actually flooding the network with so cheap electricity that we actually can't cope. And we've got to run power stations for night time, and we're running them out of business. So they've actually been, am I right? They've almost been disconnect fees and charges, and
they have in certain. I mean, America, each of the states.
Yeah, about to say slightly different, isn't it? But that point is, it's because of the dramatically lower cost of.
It's dramatically lower cost, and I think the other great example from the States, and having done a bit of work there in the past, is you just look at Texas.
Yeah.
The home of oil and gas.
Yeah.
Really.
Yeah.
And what is happening there? They are building huge solar parks.
Well, they've got a lot of spare ground.
Land it's very cheap. It's very easy to build
and quite sunny.
Get a big stretch of land and put a solar park down in Texas. But lots of wind as well.
Lots of wind, yeah.
So the home of
out in the panhandle, isn't it?
Yeah.
Yeah.
The home of oil and gas is deploying huge amounts of solar and wind.
Yeah.
So I think it just goes to show you that it's not, even though some people may want to stop the world and get off, the economics will take over.
Okay, so let's just finish off with a stop the world and get off. Whenever I live in the countryside, and whenever anybody suggests that they're going to put solar panels out, there's the usual brigade, who I might point out don't like buildings in their area either, but they usually come out and go, well, there's not enough sun in the UK. I don't really understand why you're going to put these solar panels, and you could have it for farming and food and that kind of stuff. Yeah, let's not look at the argument about what you use the land for, because that's ultimately a decision the farmer and the landowner takes. But let's look at the sun issue.
The sun issue, yeah.
Let's be honest, the UK is not notorious for being terribly sunny. So I can understand why you might do it in Spain, because there's a lot of sun in Spain. Yeah. But is it economic to do solar in the UK? It obviously is, because you have. But explain to me how that works.
Yeah, I mean, it must be, because we've been...
Because you've been doing it, yeah. You're paying a dividend, yeah, exactly.
Years and paying off exactly. So, yeah, it does work. It's just, again, it's all just down to the structuring, how much you're willing to pay for these investments up front, and the income that it's able to generate. So, obviously... what we call the irradiation, which is how strong the sunshine is. And we know this from either being outside here on a sunny day or going to Spain, where you probably get burnt in a few.
Well, you definitely get that walking outside today in London. I can tell you that.
Not today, no. But at the end of the day, the solar panels, they are very absorbent. So in terms of, you think like a leaf and the chlorophyll, it's the same kind of thing. Plants grow here in the UK.
Yeah, a lot of them.
So actually... helped by the water as well.
Helped by the plentiful supply of water, yeah. If only we could find a way of damming it and putting it in reservoirs. But that's another story. Anyway.
but anyway, look, even just sort of a relatively overcast day, these panels are still working.
Yeah, that's what's interesting, isn't it?
So going back to that point you say, and we say about reliability, pretty often, I mean, day follows night. Yeah. And that's enough, unless it's really those really dark grey days or stormy days when you're getting up and you can't tell the difference between whether it's daytime or twilight, really. Yeah. That's when you get a lot of, that's when they become a lot less protected. But also, we factor it into our profiles. Obviously, we're not expecting anything at night, or we can charge the batteries up. But also, it's enough to factor in that we're expecting to get less in the winter, when we'd actually tend to get the teams out doing more maintenance. Yeah. So peak times would be from sort of like now for the next 6 months all the way through to autumn, really, is when you're generating.
And the thing about it is solar is quite reliable in terms of what they call dispatch. So if you're sitting in the control room at National Grid and you want to know tomorrow what the weather, what power is going to come in, what it's going to be like, obviously in December the 21st, you're probably not sitting there relying on solar.
Not your only bet.
Not very much. Yeah. You'll probably get a little bit, but not very much. You might get a lot more wind, but in the middle of the summer, you might say, oh, well, actually, I know I'm going to get a lot of solar, so they'll like that.
Exactly.
Okay, so let's finish off. So I suppose the very last question is, how do you get that share price back up? Yeah, to its net asset value, really, isn't it? Because that's the crucial question, isn't it? Yeah, presumably for a lot of the time you've been trading at a premium. I mean,
for most of the years, I think, and not just us, but most of the
most of the has,
and that, as you know, that's what we need, really. The share price needs to be at least in line with NAV or above it.
And your NAV is what? How many pence?
It's 118. 118
pence.
We're currently trading at the miserable 85p.
Oh, damn. So how do you get it back up to 118?
I mean, the thing is, and I kind of speak for the sector here a little bit as well, is because, look, we're all in a similar position. The challenging bit at the moment is there's various levers that we have.
Because you could do buybacks.
We can do share buybacks that we've done a lot.
We've done a lot
so far. We've sold assets to prove the value.
Yeah.
So we actually sold 50% of one of our portfolios in Spain at 21% above what we were holding it at.
Shows you it's worth it.
Shows it's worth it. There's also,
you could increase the dividend.
We've increased the dividend.
Yeah.
tick.
The directors could buy more.
The directors did buy more.
Okay, just checking. Yeah.
So check that as well. Our share and our seat bought more at what they thought was a good price.
Yeah.
Now they probably might have waited.
Yes.
So we've done all of that. And I think fundamentally, and it has, to be fair, like ourselves and a lot of our assets are UK based. There's also been, as you know, there's been some big transactions in the market that help prove the prices there. I think the fundamental issue at the moment is we know what the yield is, we know that the prices are fair. It just doesn't seem to be enough for the large institutional buyers at the moment.
Yeah.
So a lot of them are still selling down, and they've got they're getting redemptions, which means their investors are asking them to sell and return capital. I think we're a bit of the end of the year near the tax year as well. So I think the two things that will really help now is, one, the Bank of England coming out and saying that they're going to actually start cutting.
And when they start cutting interest rates, that will make a difference.
Because what you've got to do is the yield that we're giving versus what are the other options out there?
Yeah, but because if you can get 4.5% from something that's totally risk-free and 9% for something that is a bit riskier, it is a bit riskier, then you might think, is 4.5% enough? I personally think it probably is.
I think that's it, but that's the way that I guess bigger institutions are looking at it. So there is a route here for people to take their own view on what their risk and return rewards are. But I think the other thing is there could well be some consolidation in the sector.
Yeah, so M&A activity
might help that, because there's a lot of trusts out there, and do the investors just want bigger vehicles out of it at the end of the day as well?
Well, I think that maybe the investors don't, but I think they're going to get bigger vehicles. It's whether what investors want and what they're going to get is two maybe different things. Exactly. Okay, Ross. So I think that's very, very interesting, and I'll also share with you that I'm actually having solar panels fitted on my house next week, and the cost of it has come down dramatically with batteries. So I'm going to turn it to my own mini Foresight Solar and see whether or not the savings that were promised will deliver, which I'm not entirely convinced they will. But
you can always compare notes with our portfolio director.
On
years
exactly, and I'll just check. Well, I'm hoping there's enough sunshine in the bottom of Hampshire, and if not, we're all doomed. We're supposed to be in a microclimate where I live, and I can tell you, I haven't spotted the microclimate in the last 6 to 12 months. Anyway, so very interesting. Thank you very much, Ross Driver, for that kind of spin through the world of renewables, solar, and I hope from what you can see is these idea of alternative infrastructure assets, which are investment trusts. They can fit in this kind of middle ground. They are equities, but they've got more kind of low volatility, more income orientated profiles, and that can work for the investor who's looking for a sensible high single digit total returns. Not without risk. I hope we've said that. It's definitely not without risk. But if your target is in that kind of 5 to 10% range, even more 7 to 9% range, think about renewables and infrastructure assets generally. Anyway, you've been listening to me, David Stevenson, a Resilient Investor. Good luck investing. Bye-bye.